Hey there, Iggy the Investing Iguana here. Today, we're talking about something that's got a lot of investors excited: DBS's whopping 7.1% dividend yield. That's right, 7.1%. In a world of low interest rates, that's like finding a unicorn in your backyard. But hold on, before you go all in, we need to ask the big question: is DBS really a buy right now? In this video, I'll dive deep into DBS's recent performance, the good, the bad, and the ugly. We'll look at what's driving that juicy dividend yield and what risks you need to watch out for. By the end, you'll have a clear understanding of whether DBS deserves a spot in your portfolio. And don't worry, I'll break it down in a way that's easy to understand, even if you're new to investing. So grab a snack, sit back, and let's get started. In 2023, Singapore's three major banks, DBS, OCBC, and UOB, all reported record high profits. This was indeed a cause for celebration, as it indicated a robust financial performance and a healthy economy. However, the reaction from investors was mixed. DBS, in particular, saw a positive response, with its share price climbing above 34 Singapore dollars at one point. This surge could be attributed to a variety of factors such as strong financial performance, effective management strategies, or positive market sentiment towards the bank. On the other hand, OCBC and UOB experienced a drop in their share prices following the announcement of their earnings. This might seem counterintuitive given their record profits. However, share prices are influenced by a multitude of factors beyond just a company's profitability. These can include future earnings projections, market volatility, investor sentiment, and broader economic indicators. For instance, if investors had expected even higher profits, or if there were concerns about future growth prospects, it could have led to a sell-off, thereby driving down the share prices. Additionally, external factors such as economic forecasts, geopolitical events, or changes in regulatory policies can also impact investor sentiment and subsequently, share prices. To gain a comprehensive understanding of the financial performance of Singapore's three major banks, DBS, OCBC, and UOB, it's crucial to delve into the details of their full-year results. There were several positive aspects that stood out in 2023. Firstly, all three banks increased their dividends, which is a portion of earnings distributed to shareholders. This is generally a sign of financial health and profitability, and it also indicates the bank's confidence in their future earnings potential. DBS went a step further and proposed a bonus issue of 1 extra share for every 10 existing shares. This is a strategy often used by companies to reward shareholders without reducing the company's cash reserves. Another positive indicator was the bank's asset quality. This refers to the quality of loans that the banks have issued and is a key measure of a bank's financial health. A low level of bad loans, as reported by the banks, suggests that their customers are generally able to repay their debts, which bodes well for the bank's future earnings. Lastly, the banks reported strong fee income, which is the revenue generated from fees for services like credit cards and wealth management. This is a significant source of income for banks and can be a more stable revenue stream compared to interest income, which can fluctuate with changes in interest rates. Despite the positive indicators, there are certain concerns that have emerged from the full-year results of Singapore's three major banks, DBS, OCBC, and UOB. One of the primary concerns is the slowing down of loan growth. This is a crucial aspect as loans are a significant source of income for banks. The slowdown could be attributed to higher interest rates, which make borrowing less attractive. As interest rates rise, people tend to borrow less, and this can impact the bank's loan portfolios. Another concern is the pressure on the bank's net interest margins, NIM. NIM is a key profitability indicator for banks. It is essentially the difference between the interest income generated by banks from their lending activities and the interest they pay out to their depositors. A high NIM indicates a more profitable bank. However, DBS and UOB reported a decline in their NIMs, which could be a sign of increased competition or changes in the interest rate environment. On the other hand, OCBC managed to report a slight improvement in its NIM. This could be due to a variety of factors such as effective interest rate management, changes in its loan portfolio, or a decrease in the cost of funds. As we look ahead to 2024, Singapore's three major banks DBS, OCBC, and UOB are bracing for a challenging year. They are predicting a slowdown in loan growth, which is a key revenue source for banks. This could be due to a variety of factors such as a slowing economy, tighter lending standards, or higher interest rates making borrowing less attractive. In addition to this, the banks are also expecting slightly weaker net interest margins, NIM. NIM is a critical measure of a bank's profitability, representing the difference between the interest income generated from lending and the interest paid out to depositors. A decline in NIM could be due to increased competition among banks, changes in the interest rate environment, or a shift in the bank's loan portfolios. However, it's not all gloom and doom. The banks are optimistic about the growth of fee income, especially from wealth management services. Fee income is a significant source of revenue for banks and can provide a stable income stream. Wealth management services, in particular, have been a strong growth area for banks, driven by the increasing wealth in Asia and the growing demand for financial planning and investment advice. For investors, the financial performance of Singapore's three major banks DBS, OCBC, and UOB presents an interesting scenario. Despite the potential challenges in 2024, these banks continue to offer attractive dividend yields of 6% and above. This is a significant return, especially in a low-interest rate environment. DBS stands out with the highest dividend yield at 7.1%. This means that for every dollar invested in DBS, investors could potentially earn a return of 7.1 cents. Following closely is OCBC with a dividend yield of 6.4%. These high dividend yields can provide a steady stream of income for investors, making these banks an attractive option for those seeking consistent returns on their investments. However, it's important for investors to keep in mind the potential headwinds that these banks are facing. The predicted slowdown in loan growth and weaker net interest margins could impact the bank's profitability in 2024. Therefore, while the high dividend yields are enticing, investors should also consider these factors when making their investment decisions. In addition to the attractive dividend yields, DBS has proposed a bonus share issue. This is an opportunity for existing shareholders to receive additional shares at no extra cost. The record date for this bonus issue is April 23, 2024. This is the date by which investors must own shares in DBS to be eligible for the bonus issue. So, if you're considering investing in DBS and want to take advantage of this bonus issue, make sure to mark this date on your calendar. Alright, let's recap what we've learned today. DBS is offering a tempting 7.1% dividend yield, which is fantastic in this low interest rate environment. Their profits hit record highs in 2023, and they've even proposed a bonus share issue. However, there are some potential headwinds to keep in mind. Loan growth is slowing, and net interest margins are under pressure. DBS expects a slightly lower return on equity in 2024 compared to 2023. So, is DBS a buy? Well, if you're looking for a reliable income stock and you're willing to ride out some short-term fluctuations, DBS could be a solid choice. Just remember to do your own research and consider your personal financial goals before making any investment decisions. If you found this video helpful, give it a big thumbs up and subscribe to the Investing Iguana channel for more insights on navigating the wild world of finance. And if there are any other topics you'd like me to cover, leave a comment below. Remember, investing is a marathon, not a sprint. Stay focused, stay learning, and stay awesome. Catch you next time on the Investing Iguana.